following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
Welcome to Volatility Views, your weekly source for all things volatility related. My name is Mark Longo from the OptionsInsider.com, as well as the Options Insider Radio Network. And I am joined here on this lovely summer day by my equally lovely co-host, good old Don Schlesinger from the Volatility Exchange. Don, welcome to the program, sir.
Thank you, and I'm anxious to get out and bask in some of that sunshine. We've got a spectacular forecast for the entire week coming up, so it looks like summer is upon us.
Summer is indeed upon us. And you like how I switched it up there? I went from dark side to lovely, just to keep you off your game a little bit.
Yes, I was going to comment on that.
I know you love your descriptive terms, so I'm trying to keep you guessing, sir. All right, and with that, we're going to dive right into our volatility review.
It's time for the Volatility Review.
All right, and welcome to the Vol Review. This is, of course, where we look back on the week's worth of volatility action. And because we have such a great guest waiting in the wings, Don, to talk about corporate bonds and how they react to equity volatility, we're going to keep our Vol Review brief this week and just focus on the old NASDAQ. So, Don, was an interesting week from a NASDAQ vol perspective. What in particular caught your eye over the past week's worth of activity?
Well, listeners will recall, because it's becoming somewhat of a broken record, that for the past several weeks, not only in reviewing this past week, but in giving a hint of perhaps our forecast or crystal ball at the end, that I had been observing this gentle, if you will, upsloping line of the plotting of realized volatility in terms of the NASDAQ. And my take has been that until we get any type of evidence to the contrary, the best thing that we can do is to simply predict that this kind of action is going to continue. And I think that that was, in fact, my forecast last week in looking at about 19.6 realized volatility for 21-day trailing or historical. And indeed, as we look today, we're up to 20.7. So we have once again gone higher and once again done so in sort of a gentle fashion, so that basically that trend seems to be continuing. Mark, Sebastian is not with us today, but I'll take just one extra second to make a very brief comment insofar as VIX or S&P volatility is concerned, and that is here we are taping this on a Friday afternoon where very typically VIX starts to trail off due to the weekend effect that we've alluded to many times. Not only that, but currently S&P is up about 8 handles as we record this. So you would further expect the effect of rising S&P to impact VIX in a negative fashion and lead to a declining VIX. But instead, we see that it's up fractionally, just a hair over 22 as we speak. And as such, you might be seeing the effects, as everybody is aware of the impending Greek election on Sunday. And we have so many different analyses of that and who actually is ahead at the moment, which of the two parties, and what a victory for each might mean in terms of the euro and Greece's economy and how that's going to affect volatility. So I think some of that is clearly being priced into VIX on a day, Friday, and market action up, where we would expect VIX to have been down this afternoon.
Yes, everyone's keeping their powder dry ahead of the big Greek election, because obviously no one wants to. Everyone's seen over the past year the literal effect weekend risk can have on the markets, and so no one wants to go into this weekend. Even you, Don, a sell or don't sell kind of guy, I'd imagine this is the time when you would be leaning towards the don't sell side of the equation.
Yeah, this is a don't sell for the time being.
All right. And with that, we're going to close out our volatility review and dive right into our volatility viewpoint segment.
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
All right, and that funky music means it's time once again for the Volatility Viewpoint segment. This is, of course, the portion of the show where Don and I bring on an esteemed guest from the world of options and or volatility and proceed to pick their brain for their next 20 or 30 minutes or so. And today's guest / victim is Madhu Kalimipalli. He is the Associate Professor of Finance and the Director of the Financial Services Research Center at the School of Business over at Wilfrid Laurier University in Waterloo, Ontario. Madhu, welcome to the program.
Thank you very much, Mark and Don.
That's quite a title there. You must have an extensive business card. It must be very large.
Well, what's in a name?
Well, Madhu, as we are wont to do here on the Volatility Views program, since this is your first appearance on the show, why don't you give our listeners a brief overview of your background and how you found your way to focusing on this relatively unique area of research?
Well, thank you so much. Actually, I got into fixed income as a area of my dissertation research, as I ended up working with one of the veterans in the research, Professor Arthur Varga, who was a professor at University of Houston Business School. So if you remember, Varga was the academic scholar who set up the fixed income databases in US. So he was my PhD advisor, and I started working with him, and that's how I got into fixed income 10 years ago. So since then, I've basically been doing work in fixed income, and recently, that's about 5 years ago, I spent a sabbatical at Bloomberg, New York, in their fixed income research group, working with Peter Carr. And one of the key questions we were addressing at that time was how or why does liquidity matter for corporate bond pricing? And that's when we got into what really matters for pricing corporate bonds. Does any of the information from the equity markets / equity volatility matter at all for corporate bond investors? And that took me into this route where we got into studying the close connections between the equity and the bond markets. And that is basically going to be my theme of today's talk.
Well, thank you for that, Madhu. And as listeners, in case you haven't guessed already, we're going to go off onto a new tangent for the Vol Views program today. And Don, I'm a little excited about it. I don't know about you, but we're breaking new ground here today on the program. In the past, we've had a legion of guests on this show over the past year or so, talking about just about every imaginable aspect of equity and index option volatility that you can think of. We've gone pretty far into the weeds from with some of the topics and academics that we brought onto the show. We've even taken a few forays now and then into the world of OTC variance and OTC vol swaps, but I think I can safely say we're stepping into new territory today for vol views because we're going to cross over, as Madhu indicated, into the uncharted, or at least for us, uncharted world of bond volatility. So, Don, are you ready to take the journey, sir?
Well, I'm happy to, and I think we should, because you know that our very first product at the Volatility Exchange was on the euro currency, and obviously, as the future unrolls, we certainly hope to be developing products on any underlying that the investment community would be interested in insofar as trading volatility. It's actually timely that the announcement was just made recently that CBOE is bringing out a VIX index for interest rates on swaptions. And so the concept that the public may very well be interested in trading volatility on a broad variety of underlying assets is certainly one that should be appealing to our listeners, and we're going to be very interested in what Madhu has to say about treasury and corporate bonds, volatility, interaction with the equity markets. So we're all ears.
You're right. That was an interesting and relatively timely announcement from our friends over at the CBOE about that VIX of fixed income. Perhaps we'll get into that a little bit later in the show because that's an interesting topic. I'm not sure if Madhu has had a chance to really process that announcement yet. But I think with that said, I think we'll just dive right in. Madhu, we've discussed treasuries on the show in the past, but usually we do it through the veil of products like, let's say, the TLT, using it as an indicator for what's going on in the broad market. But we haven't really jumped into the world of treasury or even bond volatility in much depth at all. So that seems like a pretty good and a pretty broad place to start. In your research, what sorts of correlation are you seeing between overall equity market vol on one hand and then the treasury markets on the other?
Yes. So I think it's a very timely question. Let me answer it this way. Whatever is a bad news for the equity market is typically a good news for the treasury bond market. So when there is excessive volatility, i.e., VIX jumping up overall, investors then try to jump out of the equity markets and going to chasing the treasury bond markets. So having said that, you will tend to see a negative correlation between the stock and treasury bond returns arising out of the phenomenon I just described whenever VIX registers a high volatility phase, right? So what happens is, let's say when the VIX hits very high territory, because there is an overall aggregate uncertainty in the economy, the correlations between the stock and bond become negative and high. So in other words, going back to your question, so during excessive volatility periods, these negative correlations between the stock and treasury bond markets could jump to 0.50, 0.60, 0.70, in terms of correlation. And that negative correlation is closely tracked by high VIX in the market. So that is itself interesting that, yes, we tend to focus a lot about VIX going high. There is a negative sentiment in the market, and that somehow gets priced in the implied volatility smiles, as we know, in the option market. But there is also the other phenomenon as to how investors chase quality, chase liquidity, and in the process migrate to the treasury bonds. And you will see that the yield curve then shifting downwards, or in other words, the correlations between the stocks and treasury bond returns becoming negative. And that is a phenomenon that has been observed in the treasury markets for quite some time and has been documented well.
So you're saying that everyone's pretty much, I assume most of our listeners on this show, we have a relatively sophisticated audience, Madhu, are aware of the basic inverse correlation between equities and bonds. But you're saying that in times of extreme duress, then, when the VIX is shooting up and the volatility is shooting up, that typical inverse correlation becomes that much more pronounced and that much more marked in that type of environment.
Exactly. And interestingly, previous academic studies have shown that if you were able to also look at the turnover, aggregate turnover, so let's take the top 40, 50, 100 companies in the U.S., kind of get each of their turnovers and get a evaluated turnover of these 100 companies in U.S., for example, and use that also as another information source. So you have VIX on the other side, and then you have stock turnover as the other variable. And somehow you're able to tease out the news, so the shocks either to the VIX or shocks to the turnover. So shocks here refers to unexpected movements in each of these variables. So what these previous studies have found is that you can actually, if you're a trader, you can use information from VIX or you can use information from aggregate stock turnover to somehow predict how these negative correlations or correlations are going to move in the subsequent periods, and accordingly you can time the market to your advantage.
Now, Madhu, what you're describing now is actual price movement correlation, as well as when we were speaking about VIX volatility levels that actually follow price movements. We know that in the equity markets, yes, we have this skew effect whereby the volatilities of the options below the current market levels, and particularly as driven by the out-of-the-money puts, are traditionally much higher than the at-the-monies or the above the market. And I'm wondering, because these skews vary, and for example, we know in the currency markets they don't look like that, but are rather more U-shaped, what kind of skews we see in the bond markets insofar as implied volatility is concerned, and also whether we have that similar kind of correlation between when prices are going up, what's happening to typically implied volatilities and vice versa.
Yeah, that's a great question, actually. So those implied volatility smiles or smirks that you described, I don't think are evident in the interest rate data. So interest rate options, to my best of my knowledge, don't have those systematic biases. And secondly, the asymmetric behavior, so that is also there in the interest rate markets, in that interest rate markets generally try to respond more to negative news events versus the positive news events. So that kind of an asymmetry, which is there in equity markets, is also there in the bond markets, generally speaking. So that is a researched area, and people understand the evidence of such asymmetry in the bond returns, for example, treasury bond space. Yes.
Now, Madhu, you mentioned that traders out there could use the stock turnover shocks or the VIX, either variable they wanted, to really help to predict the degree of that negative correlation going forward with the bonds and the equities. Have you found in your research that one is preferable over the other? Does VIX outperform, or does the stock turnover outperform? Which of those variables is preferable, or maybe using them in conjunction is preferable?
Yes. So just to clarify, my research then is mostly in the corporate bond markets, which is the next thing I'm going to talk about. So I just gave you the example of treasury bond markets to tell you what people have been doing with respect to the treasury bond markets before. Okay. And the second point is with respect to these two variables, whether it's stock volatility or whether it is VIX or stock turnover, which is more informative, I think both seem to have information content in them, and they are orthogonal to each other, which means that both variables seem to add informativeness in trying to predict the next period correlations, stock and treasury bond correlations.
So if you're modeling this, you're best off incorporating both, I'd imagine. The more data, the better, I suppose.
That is correct. And not only you need to have both variables, but there's also some kind of nonlinearity in them, in that the relationship of the impact of VIX or excess VIX or excess turnover on the correlations seem to be asymmetrically high during high volatility episodes or high liquidity episodes. So you can think of regimes in the economy where economy is moving between high and low regimes, so high VIX regime or a high liquidity regime. In such regimes, the impact of these two variables on the correlations gets even more exacerbated. So the relation is not simply a linear regression, but there could be also some nonlinear effects on the play in terms of influencing the correlations between the treasury and stock markets.
Well, thank you for that, Madhu. And you mentioned earlier most of your research is focusing on the corporate bond side, and I imagine a lot of our listeners are focused on that as well, because most of our listeners are out there trading the equity options and the equity underlying. So the bonds on those underlyings would also have some interest to them. So let's take what we just talked about and take it one step farther and apply it to the individual corporate side. If I'm looking at the volatility, let's say, of a particular underlying, particular equity, how does that, in your research, how are you seeing that really shake up and correlate to the corporate bonds on the underlying? Is it the same sort of pronounced effect we see during times of extremely high volatility? You see that same ramp up in negative correlation, or is there a different effect you've noticed?
That's absolutely right. So here, when we talk about equity volatility, we are referring to the individual firms. So let's say you have a stock called General Motors. So you're now trying to, or Ford, you're trying to link the volatility of each of these companies specifically to the bond spreads of those companies. So it's like one-on-one. And typically what we find based on an aggregate study of bond transactions over a period of 10 years of all the companies in US is generally that the volatility has a first order impact on the bond spreads. So bond spreads, think of them as the cost of borrowing for an issuer firm, or what an investor demands as a spread over and above an equivalent maturity treasury bond, right? So the idea here is that when the underlying equity volatility goes up, either it could be historical volatility, or it could be implied volatility, or it could be simply idiosyncratic volatility, which is simply the volatility of the firm after adjusting for all sorts of market factors. If that volatility were to go up, let's say 1 sigma, so that is a 1 sigma shock, is going to impact the spreads over anywhere from 108 to 111 basis points. So each basis point is equal to 0.01%. So that is a tremendous effect. So each volatility shock has about 110 basis point impact on the bond spreads at a monthly level, right? And that to us was interesting because for a lot of listeners out there, you may not be aware then that the equity volatility we kind of get so focused on, either through historical volatility or implied volatility, is also a very important ingredient into corporate bond pricing. And a lot of hedge funds, as you know, also do engage in what is called as a capital structure arbitrage, where they are basically trying to price out equities and corporate bonds out of a balance sheet of a given firm. So to them, they are always looking to engage trades in both sides, that is corporate debt and equity. And for those traders, information from equity volatility will be tremendously useful in trading to predict how bonds are going to go.
That's a surprisingly specific result. You know, usually we bring in a lot of academics talking about their research, and we talk about generalities and different vagaries of different volatility concepts and how they impact different marketplaces. But the fact that you could trace it to that 1 sigma move, to that specific correlation with the bond spreads is interesting, I think, for us and also for our listeners, that it's so in depth and so specific to that information. That's really fascinating.
Absolutely.
So in fact, Madhu, what you really have here is not only the basis of a pure speculative trade in the bond market in terms of spread traders keeping an eye on the individual stock volatility for hints as to how those spreads might move, but you also obviously have the possibility for inter-asset and inter-market kinds of spreads by actually trading the stock volatility against the bond spreads in an effort to possibly do some sort of hedging or some sort of arbitrage there as well.
Absolutely, absolutely. And look at it this way, Don, that if you were to see a particular firm which has publicly traded debt, but on the other hand, its equity is not very liquid. So you could use a benchmark firm and get the benchmark firm's equity volatility as some kind of a proxy, and then see how that benchmark firm equity volatility could then be better used to pricing the publicly traded debt of that company. So you can absolutely do all kinds of spread trades based on the equity volatility that I just described.
That type of research could have profound implications across the board, even for people who are, let's say, not as sophisticated, to be tuning into a program like this and listening to the vagaries of equity volatility versus corporate bond spreads, but just typically like to use bonds as a hedge to their portfolio or some sort of diversification tool. They also should be cognizant of this relationship, because in times of pronounced volatility, their cost of doing business in the bond world is going to become markedly higher. And so that's something I think just in and of itself is an interesting correlation to discuss and disseminate to the broader investing public.
Absolutely, Mark. And if I might just add a quick note to that, and that effect, i.e. that the volatility has a first order impact on the bond spreads, gets more pronounced for distressed bonds and during distress regimes. So when I say distressed bonds, I'm talking about low-rated bonds. I'm talking about bonds where the book-to-market of the firms is very high, and basically high distress regimes are the periods where there's a high VIX, or when there's an overall aggregate volatility is very high. So in distress times and distress portfolios, that volatility has even bigger role to play for the bond spreads, and that's why it is so important to better model the equity volatility for the kind of reasons I just said.
Madhu, very often when we have professors and academics on, and we sort of cross over to ask questions that then would relate to trading or to real-world applications, we're well aware and we understand that aspect is not the specialty of our particular guest. But I'm wondering, in your case, having enunciated these relationships and these views, if you are aware of just how widespread and how widely known these relationships are, insofar as you're the one who researched and found them, and whether or not there may be entire trading operations or parts of trading operations that are now devoting funds and time and energy to doing this kind of trading.
Right, Don. So the story that equity volatility matters for bond spreads is not new. People know it. People have been looking at it for quite some time. But what is new, what we found in our research is the following, that, look, there is equity volatility, but there is also the other side of the coin, which is called illiquidity, that is bond liquidity. And liquidity, as we have come to understand through the crisis, is also a huge factor in influencing the prices of financial instruments. So equity, for example, the investors chasing equity, will demand a huge equity premium for liquidity when the markets are generally low in liquidity. So what I'm trying to get at is that just the way volatility matters for bond spreads, the bond illiquidity also matters for bond spreads. So what we found new in our research is that, while volatility has the first order impact on bond spreads, the bond illiquidity has also a non-trivial and a second order impact on bond spreads, and that also needs to be well understood for a bond investor to go and price these bonds correctly.
So I'd imagine if you had a substantial amount of volatility in a bond that was highly illiquid, you would see a very, very pronounced effect on those spreads, a much increased order of magnitude to what you would see with either of those alone.
That is correct. So unlike in equity markets where it's kind of easy to diversify away the stocks and reduce the idiosyncratic risk to almost zero, in bonds that is not easy. So in bonds, however well you diversify, the idiosyncratic variables, we're talking about variables such as the ratings of the bond or maturity of the bond or which industry the bond is or the amount outstanding of the bond issue, all these variables continue to play a non-trivial role even after you condition for market factors. So what it is that for bonds, they are generally illiquid compared to equity market. But one other fact that I'm going to throw at your audience is the following. There was a study that was done a few years ago which looked at all the balance sheets of the companies over the world, and they found that, believe it or not, about 87 to 90% of the capital is actually raised through debt. And equity is only about 9 to 10%, at most 14%. So a huge part of the balance sheets of the firms all over the world is raised through debt, which is something like 87, 88%. And it only behoves us to understand then how these bond spreads are determined, how these bond markets are, and using information from equity markets.
That is a fascinating stat because we tend to refer to equity first and foremost as a primary gauge for the liquidity and the interest in the capital of a company, when it really probably should be the exact opposite, when so much of the capital of these firms is really being raised and is at play in the actual corporate markets.
That is correct, absolutely. And another thing is that unlike exchange, so for example, you can go to Yahoo Finance or Google Finance and try to find out where the stock is trading at. The prices on the stocks are pretty obvious and transparent. But that is not the case for corporate bonds. So that is why people, companies like Bloomberg and Reuters, especially Bloomberg, has such a big role to play because fundamentally corporate bonds are non-transparent bonds, non-transparent financial instruments. So for such illiquid, non-transparent instruments, there may be some information from the equity markets to go and price them, and that is the kind of result that hedge funds and investors may be interested in.
Now, Madhu, you mentioned some of the variables that went into your research earlier and how they impacted your results. I'm concerned or interested in one particular variable, that is maturity. We've had people on the show in the past, academics, talking about various products, usually OTC products, OTC variants and vol swaps, and different aspects of research on those. And their research tended, and the results they found tended to be very precise for near-term maturities. But the farther you went out, 6 months or plus, the results and the accuracy of their research tended to diminish. I'm curious if you saw a similar correlation or similar result here with your findings, where you found a pronounced, let's say, that exact sigma to percentage bond spread relationship that you mentioned. You found that much more pronounced in the nearer term maturities, but then as you started going farther out along the yield curve and into longer term bonds, you found if that relationship was diminished in any capacity.
That is correct. I think the maturity is also an important issue in this sort of pricing. We see that for short-term bonds, which we define as sometime below 5 to 7 years of maturity, the equity volatility and bond liquidity measures seem to have a biggest impact. But for long-term maturities, liquidity doesn't matter as much. So what it is that we have this interesting result for low-rated bonds and for short-term maturity, that is near to maturity, both volatility and liquidity effects play an important role in driving bond spreads. But on the other hand, if you go away towards better-rated bonds or investment-grade bonds, and if you're looking at long-term bonds, that is above 7 years, it is all volatility that seems to have the most effect on the bond spreads.
Wow, that's surprising. And that actually is interesting then, because you've essentially, by doing that, eliminated one of the variables from your model. So it sounds like if you're looking at taking this approach and looking at modeling and trying to trade equity vol versus the corporate bonds and the corporate bond spreads, that you're better off focusing on that AAA long-term corporate end of the curve where you could just model essentially this one variable and get that benefit. Whereas if you migrate to the other end of the spectrum, the near-term junk, you have many more variables to process and the outcome is a bit more uncertain.
Absolutely. So think of it this way then. If you were able to construct a meaningful volatility measure for the firm, either using some kind of a idiosyncratic volatility, that is volatility that is just specific to the firm, using some information from the historical volatility or implied volatility, if you get a very robust measure there, and if you somehow end up also calculating a robust measure of bond illiquidity, then you're able to pretty well measure the bond spreads or predict bond spreads of the underlying firm pretty reasonably.
Now, perhaps one final question, Madhu, whereas your area of expertise lies in these volatility effects of individual equity on the bond markets, it might be interesting to speculate a little bit when you bring in the liquidity issue as to how actual equity or stock market volatility matters in terms of pricing when you throw in the liquidity factor as well. So you seem to have studied almost on a matrix, changing stock volatility and its effect on the bond spreads, but also simultaneously the effect of the liquidity and how that may exacerbate or actually magnify the effect of the volatility. How about applying that same type of methodology to actual equity pricing?
Equity pricing, yes. So in equity pricing, we have a very interesting story that once you condition, so in other words, you're trying to explain equity returns, and you're trying to explain them using a bunch of variables, two important being the underlying equity volatility and equity liquidity. Now, a very authoritative study found that once you include volatility, the liquidity doesn't seem to have a lot of impact in explaining the stock returns across firms. So in other words, volatility seems to pick up a lot of variation of returns across firms. So liquidity effect gets washed away. Now, that result doesn't hold for bond markets. In bond markets, however you cut the sample, you find that volatility and liquidity together seem to have an impact. So liquidity does not get washed out by volatility, and that happens for the distressed portfolios. So distressed portfolios are the ones which are low-rated firms, short-term maturity firms, are firms with high leverage, and so on. So such firms, both volatility and bond liquidity seem to matter, but for other firms, it's only volatility seem to matter. So all that I'm trying to get at is that equities are different animals compared to bonds. In equities, volatility seems to be has the complete effect compared to liquidity, whereas in bonds, both variables, i.e. volatility and liquidity, seem to matter depending on the portfolio.
Well, Madhu, this has certainly been a fascinating topic, and certainly one that Don and I have never really explored on the show before. So we thank you for coming on and opening our eyes to these very interesting levels of correlation between these different products and how equity vol tends to spill over into the corporate bond world. And I think Don and I would certainly like to have you on the show again down the road to perhaps look at some more of these developments in more detail. Unfortunately, that is all the time we do have for this segment. But before you go, Madhu, since you did take the time to come on the show today, by all means, let our listeners know of any interesting papers or research or perhaps appearances you have coming up that may interest our listening audience.
Thank you, Mark. I just want to alert your audience to an upcoming finance conference. It's called Northern Finance Association. So if you go to Google and type NFA for Northern Finance Association, and 2012, which is the year, you will see a connection to it. So this is a conference we are hosting in Niagara Falls. Great weather, great location, right next to the falls. And it's one of the premier North American conferences. So I want all of you to hopefully look up what we are doing there and possible do register for the conference. Thank you.
Yeah, so any listeners in the northern or upstate New York area, hey, Don, that isn't that far from your neck of the woods. Maybe you want to take a drive up.
Not too bad. Might be nice for a little vacation.
Yes, absolutely.
There are worse places to be in the summertime than Niagara Falls, that's for sure.
Get that cool mist.
Yes.
Bring the wife up there for a second honeymoon. What do you say, Don?
It's the honeymoon capital anyway, so. Yes.
Well, Madhu, thanks again for coming on the show. And like I said, we'll definitely have to bring you on again down the road to explore some of these relationships in more detail.
Thank you so much, Mark and Don, for your time. We'll do so. Absolutely.
All right, and that is going to do it for our Volatility Viewpoint segment. And now we're going to dive right into our Crystal Ball segment.
And now we take a look at the crystal ball.
Welcome to the Crystal Ball. This is, of course, the portion of the show where we prognosticate wildly and perhaps irresponsibly about the future of volatility. And we're going to kick things off as we did in the Vol Review with a look ahead to NASDAQ. And, of course, it's a little bit difficult to prognosticate this week because you have such a wild card lurking on the weekend, which really could send us into any direction over the coming week. But, Don, are you going to dive into that fray? Are you going to keep your prognosticating powder dry as well for the coming week?
Well, here's what I'll do, and I'm happy to say that the last few weeks we've done reasonably well. I guess it's the old adage: if it ain't broke, don't fix it. I look at some of these charts and I realize that the past isn't always prologue, but I just don't really have very much reason to change what has been the sort of leitmotif for the last month or so, and that is I see this gently rising volatility both in NASDAQ and S&P, and for want of any reason to change, we'll go with that same scenario that's worked pretty well until it stops working. The only thing that I would say is we made some comments about the volatility of volatility, just how quickly volatility itself was changing. And we mentioned that had been, by historical levels, rather low itself over the past several weeks or even months. That's starting to creep up to average levels again, meaning that the actual magnitude of the movement of volatility when it does move has been more or less around what its historical norms have been. So that's sort of another reason to expect perhaps that we won't have any wild type of movement, and that we've settled into types of volatility movement that are considered more or less normal for these underlying indices.
Unless the flaming cheese folks indeed set off a cataclysm this weekend, then of course all bets are off.
There you go.
The Saganaki crowd, as you will, or perhaps the Tasty Euro crowd, whichever you prefer when you head on down to Greektown. I think I'm more of a Euro and Saganaki guy, so I go a little bit of both. All right, and that is going to do it for our abbreviated Crystal Ball segment today. And before we go, we do want to bring up one quick programming note here on Vol Views. It is actually probably good and or bad timing, I suppose, depending on your perspective, because we just had such a fantastic guest on the show here on Vol Views. So in that sense, we are going out on a high note, and by that I mean that we are going to be taking a bit of a hiatus for the summer here on Volatility Views. But don't despair. I can hear many of you throwing your iPhones and iPads and MP3 players down in disgust and walking away. But don't despair just yet, because we're not going away for the entire summer. We will be back. Don and I and the rest of the Vol Views crew will be back every expiration Friday to record a new show for you guys. So we will be here throughout the summer periodically. And perhaps in the interim, maybe we'll be able to throw together some best of Vol Views shows. So you subscribers out there will have something to listen to and something to enjoy while Don and I and Mr. Sebastian and the rest of the Vol Views team take a well-earned summer hiatus. Don, anything you'd like to add to that for our very sad, I'm sure right now, listening audience?
Well, simply that I think we've had a wonderful run by my count with our 2 introductory or preview shows way back in March of last year. By my count, this is our 60th episode of Volatility Views with today's show. And it's been a wonderful run. And as you say, we aren't going anywhere. We're simply going to take a little bit of a breather, also in recognition of the fact that on fully half of those 60 shows, we have managed to have some wonderful guests, such as the one that we had today. And it becomes just a little bit more challenging to book such guests when a lot of them are from the academic world and when school is out and people do some traveling and take some well-deserved time off. So we're just simply going to coordinate our time with theirs and come back bigger and better in the fall, hopefully to be discussing our new products that will be coming out and to have guests once again available. But as you say, we will do a show on the 3rd Friday in July, another one on the 3rd Friday in August, perhaps, who knows, even come up with a guest for one or both of those shows. So we thank all the listeners for their wonderful interest over the past year and 3 months or so, all the questions that have come in. We hope we've gotten to most of them, and we're not going very far, so we'll speak to everybody soon.
Yes, so by all means, stay tuned to the Options Insider Radio Network and stay subscribed to the Volatility Views feed because there will be more content coming to you soon in this feed, so stay tuned for that. And so with that, we're going to close out this episode of Volatility Views, and we'll see you again next time, hopefully not that long from now, right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volx Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.